The market does not move because of news, indicators, or clever opinions. It moves because of people, and more specifically, because of human weakness. If there is one thing the market is obsessed with, it is exploiting human laziness, human memory, and human fear. These weaknesses do not appear randomly on a chart. They gather, they concentrate, and they almost always gather around simple, beautiful numbers. When you see a stock approaching 100, 200, or 300, you are not just seeing a price level. You are seeing a psychological magnet. Very often, you are seeing the exact location where the maximum number of traders will experience pain. This is why the most violent and explosive market moves occur at these obvious levels, and why those who understand them profit, while those who ignore them pay a heavy tuition. Most traders do not realize that round numbers are not important because of math, but because of the human brain. The mind naturally seeks simplicity, especially under stress. Prices that end in zero are easy to remember, easy to talk about, and easy to act on during moments of fear or greed. A trader does not say he will sell at 299.37. He says he will sell if the stock breaks 300. This psychological preference for clean numbers creates a massive imbalance in the market. And that imbalance is where professional traders operate. The number itself has no power. Its power comes entirely from how people react to it. As a stock approaches a major round number like 300, two emotional forces begin to collide. Short sellers become uncomfortable because price is moving against them, and they rush to protect themselves. Almost without exception, they place their stop-loss orders just above the round number. At the same time, traders who bought much lower and are sitting on profits become fearful of losing those gains. They also protect themselves by placing their stops just below the same number. What this creates is not randomness, but a dense concentration of orders on both sides of the level. This is stop clustering, and it represents compressed energy in the market, waiting to be released. This clustering of orders is the reason breakouts at round numbers are so powerful. Stop-loss orders are not passive. When they are triggered, they turn into market orders that demand immediate execution at any available price. Forced orders always create momentum. This is why price does not simply drift through a level like 300. When it breaks decisively, it often explodes. The market is not moving because of new information. It is moving because thousands of traders are being forced to act at the same time. The fascinating part is that this process is self-fulfilling. The more traders believe that 300 is an important level, the more they place their orders there. The more orders that accumulate, the more energy is stored. Professional operators see this clearly. They understand that if price can be pushed just beyond the round number, it will trigger a cascade of forced buying or selling. The belief in the level is exactly what makes the level real. The crowd builds the trap for itself, and then confirms it when the breakout finally occurs. Not all round numbers carry the same weight. Breaking 10 is psychologically interesting, but breaking 100 carries far more significance. Breaking 300, 500, or 1000 after a long consolidation or a major trend is a completely different event. The larger the number, the more capital required to break it, and the more violent the reaction once it gives way. This is why experienced traders focus on major century levels. Magnitude matters because commitment matters, and the deeper the psychological significance, the stronger the eventual move. Jesse Livermore understood this better than anyone, and his guiding principle was always to trade the line of least resistance. When a major psychological barrier is decisively broken, the accumulated stop-loss orders ignite. If resistance breaks upward, short sellers are forced to buy. Momentum traders rush in, and sellers vanish. Price inertia disappears, and the market accelerates. This is not chaos. It is structure driven by human behavior. However, the true breakout is often misunderstood by impatient traders. A brief move above 300 followed by an immediate collapse is not a breakout. It is a trap. A genuine breakout must be confirmed. Price must stay above the level for a meaningful period of time, and it must be supported by volume. Volume is the market's psychological translator. It tells you how many traders have surrendered. A move through 300 on average volume suggests uncertainty. A move on heavy, Expanding volume signals crowd capitulation. Without volume, there is no confirmation, only professional probing. Once a real breakout occurs and the clustered stops have been executed, the market often enters what can only be described as a vacuum. The sellers who were defending the level are gone. Their orders have been filled for a brief moment. There is very little opposing pressure. This absence of supply allows price to move rapidly and with surprising ease. This is why breakouts feel fast and unforgiving. If you hesitate, the market does not wait. It simply moves on without you. Ironically, the highest probability trade is often not the initial breakout itself, but what comes after. Once the explosion occurs, price frequently pulls back and tests the old resistance level. This is known as the retest. If the former ceiling now holds as a floor, and buyers step in to defend it, the level has been validated. This provides a lower risk entry with a clear point of invalidation. It rewards patience, discipline, and emotional control, qualities that most traders struggle to maintain. Markets will always evolve. Technology will change, and strategies will come and go. But human psychology remains constant. Fear and greed do not disappear. Charts are not random collections of numbers, and they are not mathematical puzzles. They are records of human behavior. Round numbers like 100, 200, and 300 are not technical lines. They are battle lines where human capital concentrates and becomes vulnerable. When you learn to recognize these zones, confirm them with volume, and wait for the market to reveal its intent, you stop being the liquidity that professionals exploit. You begin trading with structure, patience, and clarity. And above all else, you learn the most important rule of all: never argue with the tape.